how does a company, watch its net sales just get cut in half, see its net income absolutely plummets by like 90%, and still have Wall Street cheering as its stock price goes up?
It's pretty wild.
Right. Welcome to today's deep dive. This is customized specifically for you, the learner. So if you love uncovering the hidden mechanics behind everyday headlines and getting past all that financial noise to see how things actually work, you're definitely in the right place.
Absolutely.
Today, our mission is to dissect the extreme volatility of the global food supply chain. And we're going to do that through the lens of a single, really fascinating company, which is Cal-Maine Foods. They're the largest egg producer in the United States.
Yeah, and we're looking at a financial and, frankly, an operational landscape today that totally defies standard business logic.
Totally.
I mean, when top-line revenue drops that aggressively, you usually expect, like, a 5-alarm fire. Management scrambling. Investors running for the exits.
Panic.
Exactly, panic. But Cal-Maine is navigating this with an incredibly counterintuitive strategy.
And we're basing this analysis on a stack of extremely fresh financial documents. So we've got their Q3 2026 earnings report, which literally just came out today, April 1st, 2026.
Hot off the presses.
Right. We're also looking at the live earnings call transcript, their investor slide deck, and their official Form 10Q filing. And sitting right at the top of these documents is that massive contradiction I just mentioned.
Another big one.
Yeah, a 53% drop in sales and 90% drop in net income, yet they're beating Wall Street expectations and the stock is rising. Okay, let's unpack this.
So to understand how Cal-Maine is surviving and actually positioning themselves for the future, we first have to look at the underlying mechanics of the commodity market they operate in.
Right, set the stage.
Exactly. When you sell a generic, conventional commodity, you don't really get to set your price.
The market does.
The market sets it for you, yeah. It's based entirely on supply and demand at that exact moment, and that is called the spot market.
And right now, the spot market is experiencing just violent whiplash. Let's look at the raw numbers from this Q3 report.
Lay them out.
So net sales went from $1.4 billion a year ago straight down to $667 million.
Ouch.
Yeah. And the main culprit is the price of a standard conventional dozen eggs. That price plummeted by 70.1% year over year.
That's a huge drop.
Massive. They went from $4.76 down to just $1.42.
And if you dig into the regional data, the swings are, well, they're even more aggressive. Like in the Southeast market, wholesale prices swung from $2.69 down to just 85 cents.
Wait, 85 cents?
Yeah, 85 cents in a single quarter.
That is insane. So to understand why this is happening, we have to look back at the biological shock that started it all.
Right, the bird flu.
Exactly. Last year, the highly pathogenic avian influenza, so bird flu or HPAI, it completely decimated commercial layer flocks across the country. That created this massive immediate supply shortage.
But the real driver of the price spike wasn't just the missing eggs, right? It was how retail inventory algorithms and honestly human psychology reacted to the missing eggs.
The panic.
Yeah. Supermarkets were terrified of having empty shelves, so they panic ordered. This is a classic illustration of what supply chain experts call the bullwhip effect.
Oh, man, we saw this exact same mechanic with the pandemic toilet paper shortage.
Oh, perfect example, yeah.
Yes, because it wasn't that people were suddenly using, triple the amount of toilet paper.
No, of course not.
The initial shock just caused consumers to hoard, which caused store inventory algorithms to totally break down. The stores saw their shelves emptying faster than usual, so they aggressively overordered from the distributors.
And that massive surge in wholesale demand just drove prices to the moon?
Yep.
That's the crack of the whip, essentially.
Yeah.
A tiny disruption at the farm end gets magnified into this massive oscillation all the way up the supply chain.
Crazy.
But now, look at the current quarter. The data shows the U.S. layer hen flock has recovered. It grew by 2.2% to reach about 310.8 million hens.
Okay.
And crucially, bird depopulations due to the flu are down 70.6% year over year. So the supply pipeline is, entirely full again.
Which means the supermarkets suddenly realize their warehouses are just completely packed with eggs.
Right.
And their inventory algorithms tell them to completely stop ordering. So the wholesale demand just vanishes overnight and the wholesale price absolutely crashes.
Exactly.
Even though everyday consumers at the grocery store might still be seeing retail prices adjusting way more slowly. So Cal-Maine is essentially absorbing the downward force of that bullwhip.
Yeah, but if you're a business leader, watching your core product's price drop 70% in a year, you realize pretty quickly that you can't just cross your fingers and, like, ride out the volatility.
No, you'd go bankrupt.
Right.
But
You have to actively change the rules of the game you're playing. You basically
yeah.
have to decommoditize your business.
And we see that really clearly in their pivot to specialty eggs. Cal-Maine is intentionally shifting away from conventional commodity eggs.
They really are.
In this Q3 report, specialty eggs, and by that I mean cage-free, organic, pasture-raised, nutritionally enhanced, all that stuff, they made up an incredible 50.5% of their total shell egg sales volume.
Wow.
Yeah, that is a record high. But here's where it gets really interesting.
Yeah, because specialty eggs are not just, premium products that look nicer in the carton. They are fundamentally priced using a totally different mechanism.
Right.
The vast majority of these specialty eggs are sold on what's called a fixed cost plus pricing model.
Okay, let's break down how that actually works for the listener. Because if the spot market is like an adjustable rate mortgage, where your payment swings wildly based on the broader economy.
This cost plus model is more like a fixed rate mortgage.
Exactly. It's stable.
That's a really great way to think about it. Under a fixed cost plus contract, the supermarket agrees to pay Cal-Maine based on the actual literal cost of producing that specific egg.
Okay.
So they calculate the cost of the chicken feed, the labor, the packaging, and then they add a pre-negotiated fixed profit margin right on top.
Gotcha.
It completely insulates the transaction from those wild spot market crashes we were just talking about. In fact, according to the earnings call, only about 12% of their specialty pricing is tied to the volatile California cage-free spot market. The rest is locked into these stable, structured prices.
And they're even shifting their conventional eggs toward this strategy. The transcript notes they're moving toward hybrid pricing models, blending the wholesale market index with their own internal cost of production.
Yeah, hedging their bets.
But wait, I'm looking at these past shortages where commodity eggs hit $5 or $6 a dozen on the open market. If Cal-Maine is locking their prices into these cost-plus contracts, aren't they just blocking themselves from those massive windfall profits during a shortage?
Yes, they are.
Like, why would you intentionally cap your own upside?
Well, you're hitting on the exact trade-off management discussed on the earnings call. They are absolutely capping their peak upside, but they're doing it to secure a highly elevated and, most importantly, stable price floor during a glut.
Ah, I see.
They are willingly sacrificing the eye-watering, headline-making profits of a biological crisis to guarantee they never bleed cash when the market crashes.
So they're turning an agricultural roller coaster into, like, a utility company.
Precisely. They want predictable, boring, stable margins. And for long-term investors, the kind who want reliable dividends rather than wild stock charts.
Right, the institutional money.
Exactly. That predictability is highly valuable. That underlying improvement in earnings quality is exactly why the stock can rise, even when top-line revenue is down 53%.
Incredible. But protecting the shell egg price is only step one. To truly escape the spot market, you eventually have to stop selling raw ingredients altogether and start selling finished meal.
Moving up the value chain.
Yeah. And the Q3 report details a massive, aggressive move into what they call prepared foods.
Right.
We're talking about pre-cooked egg patties, folded omelets, hard-cooked eggs, and protein pancakes.
Yeah, and they've been on a huge acquisition spree to build this segment. They bought Echo Lake Foods, they bought out Meadow Creek. They started a joint venture called Crepini, which makes specialty egg wraps. And the growth there is just explosive. I mean, the Crepini venture alone saw a 283% sales increase.
283%.
Yep. When you combine these prepared foods with their specialty eggs, it now makes up 52.9% of their total net sales. They're officially way more than just a regular egg farmer.
Yeah, no kidding.
And if we connect this to the bigger picture, you can see a strategic master plan unfolding, especially when you look at their newest purchase.
Right, the Creighton Brothers acquisition, announced just weeks ago on March 2nd, 2026. Cal-Maine paid $128.5 million in cold, hard cash for the assets of Creighton Brothers in Indiana.
A huge deal.
Yeah. It adds 3.2 million egg-laying hens to their network, but crucially, it includes a nearby liquid egg facility.
That liquid egg facility is the key.
Yeah.
Cal-Maine isn't just buying random food brands, right? They are intentionally placing their liquid egg production right next to their southern prepared foods plants.
Oh, I see.
They're building a self-contained, closed-loop supply chain. The farm produces the raw egg, the liquid facility breaks and pasteurizes it, and the prepared foods plant turns it into a pre-cooked omelet, all within their own optimized network.
Okay, I follow the logic. That makes sense. But I'm looking at their actual financial notes for this prepared foods segment, and they completely tanked this quarter.
It did.
Yeah, management openly called their margins a trough. So if moving from raw eggs to protein pancakes is the high-margin master plan, why are they suddenly losing efficiency and bleeding money doing it?
Well, it looks alarming on the spreadsheet for sure, but you have to look at the mechanical, operational context they provided. This isn't a lack of consumer demand.
Oh, it's not.
No, consumer demand for these products is actually very strong. What you're seeing is a planned mechanical bottleneck. They are completely reconfiguring the factory network they just bought.
Meaning they're actually halting production.
Yes. They literally took production lines offline during the quarter
Yeah.
to install massive new capacity. They're expecting 30% growth in this segment over the next 18 to 24 months. So they're installing lines that will eventually produce 17 million pounds of scrambled eggs and 12 million pounds of pancakes annually.
That is a lot of pancakes.
It is. But when you shut down a factory to install new equipment, you suffer from what accountants call the underabsorption of fixed costs.
Okay, let's define that for the listener really quick.
Basically, a factory has fixed costs that you have to pay no matter what, right? Property taxes, management salaries, building maintenance, insurance.
Sure.
When the production line is running 24/7, those fixed costs are spread out or absorbed across millions of pancakes. But when you shut the line down for upgrades, you're still burning cash to keep the lights on, but you're producing 0 pancakes to sell.
So the fixed costs temporarily devour your profit margin?
Exactly. It hurts the margin right now, but management expects those margins to fully recover to their 19 to 20% baseline by 2027 and 2028, once those new lines are really humming.
Okay.
It's short-term operational pain to build long-term scale.
That actually makes a lot of sense. But vertical integration and premium pricing, they only solve the financial risks. Because Cal-Maine deals with live animals and heavy industry, they can't just spreadsheet their way out of physical reality.
No, they can't.
And physical reality has diseases and it has lawyers.
Two elements that introduce massive, unpredictable liability. Yeah.
Let's start with the biology. Bird flu, HPAI, is still actively circulating. The documents note that just a few weeks ago, on March 14th, 2026, Cal-Maine had to depopulate 350,000 pullets at a facility in Maryland.
Yeah.
And just to be clear on the industry jargon, to depopulate means to systematically cull or euthanize the birds to stop the virus from spreading. And pullets are young hens that haven't even matured enough to start laying eggs yet.
So that is pure lost investment.
Exactly.
And while the CDC notes that the risk to human health from HPAI remains low, the risk to the agricultural supply chain is just severe and persistent. The sources state that 17.6 million birds have been depopulated nationwide in just the first few months of 2026. Because the virus is widespread in wild migratory bird populations, the threat of an outbreak is literally constantly hovering over these commercial farms.
And if the biological threats weren't enough, we have to look impartially at the legal hurdles detailed extensively in their 10Q filing.
Right, the lawsuits.
Yeah. First, there are ongoing antitrust investigations by the Department of Justice in several states into the egg industry's pricing practices. But the more immediate financial hit comes from a 2008 antitrust lawsuit brought by Kraft Foods and other companies.
And the mechanics of this lawsuit are really important to understand. The plaintiffs argue that major egg producers colluded to intentionally reduce the overall size of their flocks.
Okay.
In a commodity market, if you artificially restrict the supply, the price automatically goes up. They are alleging price fixing through flock reduction.
And a jury recently agreed with the plaintiffs, awarding them $17.8 million. But in antitrust law, damages aren't just what you owe, they're punitive.
Right.
The law uses a mechanism called treble damages, meaning the baseline penalty is automatically tripled.
Tripled, wow.
Yeah. The philosophy is that if a monopoly only has to pay back exactly what they allegedly overcharged, it just becomes the cost of doing business, right?
Mm-hmm.
Tripling it is meant to be a severe deterrent. So that $17.8 million was trebled to $43.6 million.
That is a massive hit.
It is. Cal-Maine is appealing, but they had to post a $23.9 million bond just to proceed with the legal process.
And beyond the antitrust issues, they're also dealing with environmental litigation.
Right. There's a long-running pollution lawsuit in Oklahoma regarding the Illinois River watershed. The court ordered a $70,000 fine for Cal-Maine.
Which isn't huge.
No, the fine isn't the real issue. The judgment includes injunctive relief requiring the defendants to fund a multi-million-dollar environmental remediation plan over 30 years.
Over 30 years.
Yes. Cal-Maine is appealing that specifically to avoid being tied to a 3-decade rolling funding obligation.
This raises an important question when you're evaluating a company operating in this space. How does an organization shoulder this intense level of biological culling, antitrust penalties, and environmental litigation without completely collapsing?
It goes back to that 5-alarm fire we talked about at the beginning. Most companies facing a 50% revenue drop alongside massive legal and biological liabilities would simply fold.
Right. They survive because they have built an absolute financial fortress. Yeah. If you look at Cal-Maine's balance sheet, they are navigating these storms with $1.152 billion in cash and short-term investments.
Wait, $1 billion?
Over $1 billion. And they are virtually debt-free.
Over $1 billion in cash and zero debt. That is an almost unheard of safety net in modern corporate finance.
It's the ultimate shock absorber. They are effectively self-insuring against the volatility of the physical world. By hoarding cash during the boom times, they can confidently pay out their variable quarterly dividends and execute $24.3 million in stock buybacks this quarter alone. It's why they can drop $128 million in cash to acquire Creighton Brothers without needing to take out a high-interest loan.
Okay, so what does this all mean? We started this deep dive looking at a company that, on the surface, seemed like a helpless victim of a 70% price crash in their main product.
Right.
But once we read through the documents and unpack the mechanics, we uncovered a deliberate, massive transformation. They are aggressively evolving from a simple commodity farmer, entirely at the mercy of the spot market, into a diversified, value-added food giant that utilizes closed-loop supply chains and fixed pricing models to control its own destiny.
They're controlling what they can control, right? Yeah, pricing structures, product mix, and vertical integration to basically build a fortress against the things they can't control.
Exactly.
But there's one final thought I want to leave you with, something that builds on their specialty egg pivot, but reveals a really fascinating tension for the future of our food supply.
Okay, let's hear it.
We talked heavily about their transition to specialty, cage-free eggs. The documents note that 10 states, representing 27% of the U.S. population, now legally mandate the sale of cage-free eggs.
Right.
That legislation is the primary engine driving this entire industry transition. But cage-free often means the birds require outdoor access, or at least open-air environments that are far less physically isolated than traditional indoor facilities.
Right, they aren't completely sealed off from the outside world.
Exactly. And as the global climate shifts, altering the seasonal flight patterns of wild migratory birds, those wild birds are bringing unpredictable rolling waves of HPAI directly into contact with these cage-free outdoor access flocks.
Oh, wow. So a wild goose landing in a pasture can infect an entire commercial flock.
Precisely. So the question we have to grapple with is this. Will the legislative push for animal welfare and cage-free environments ultimately collide with the harsh biological reality of disease control?
That is heavy.
Yeah. By legally mandating an environment that provides a better life for the animal, we may be inadvertently exposing the broader food supply to higher risks of a virus that requires total flock depopulation. It's a profound tension between our ethical goals for animal treatment and our desperate need for biosecurity.
Wow.
And how we navigate that tension is really going to define the future of what we eat.
That is an incredible paradox to end on. You fix the market volatility through specialty products, but you walk right into a biological trap.
Yeah.
Well, thank you for joining us on this deep dive. We hope this look into Cal-Maine Foods has given you a new perspective on the hidden mechanics of what it takes to actually feed the country. Keep questioning the forces shaping the everyday items in your grocery cart. We'll see you next time.